Thank you very much, Matthew and Luke and everyone at the RSA for inviting me back here to speak to you in what has got to be the most gorgeous of all the rooms that I get to speak in London, and it's always a treat. The last time I was here, last time I came and gave a speech, I gave a speech about open source politics, about how the internet and new forms of social media were changing politics and government. And many of the ideas that I raised in that speech, from using search technology to throw a spotlight on government spending, to using new open source IT in government, are now official Conservative Party policies, and some of them are now being implemented by the Mayor of London. Of course, since then, to put it mildly, quite a lot has changed, and the financial crisis has led to deep recession and a staggering deterioration in the public finances. The politics of prosperity are giving way to the politics of austerity. And the crisis has also exposed two fundamental arguments. The first is on fiscal stimulus, and the question is, should we be trying to borrow our way out of debt? David Cameron and I have consistently argued, since this issue first arose in the autumn, that we should not. To begin with, to be frank, we were almost alone in making that argument, but we held our nerve and stuck to our principles, and now informed opinion has turned in our direction. The Governor of the Bank of England has made it crystal clear that the country cannot afford a second fiscal stimulus, and judging by an interview which Gordon Brown has given to a newspaper today, he too is now in full retreat. And the forthcoming budget will mark, I believe, the complete collapse of his fiscal strategy for tackling the recession. And it will vindicate the principle of fiscal responsibility that we Conservatives have stood by in good times and bad. Now we are winning, I would argue, the first big argument. We need to take the second big argument head on. And that is the view emerging on the left of politics, that the financial crisis is also a crisis of markets in general. In Britain, it is, we see the evidence of the shift from the centre ground in the governing party, the Labour Party. And I understand that the public feel disillusioned, betrayed, and angry about financial markets. After all, they spent a decade being told we had arrived at some financial nirvana of stability and growth, only to find it was a fragile illusion of prosperity built on debt. But the view that this crisis heralds the end of market economics is profoundly mistaken, and it needs to be confronted and defeated. For despite the scale and the severity of this crisis, the economic contraction taking place will not undo the awe-inspiring increases in living standards that open markets have facilitated in much of the world over the last 30 years. China's market reforms that began in the early 1980s and India's opening to trade at the beginning of the 1990s have done more to raise the living standards of more people than any other government policy in the history of the world. Abandoning that progress or turning our backs on open markets would be a tragedy. It would return hundreds of millions of people to the $1-a-day subsistence poverty out of which they have been lifted. And that's why we need to maintain the pressure for further liberalisation of trade, world trade, in the face of the protectionist backlash. Many extend the argument that what we are seeing is a crisis of markets in general, to argue that it has also created an existential crisis for parties of the centre-right, because we're traditionally champions of market economics. And of course, this is a convenient argument for centre-left politicians in Britain, who find themselves confronted with the inconvenient truth that they were the ones who've been in office for 12 years. But it too is deeply flawed. For not only is the centre-left's case that now is the time for big government solutions, held below the waterline by the new central fact of British politics, that there is no money to pay for these big government solutions. In Britain, at least, it is based on a straw man. The idea that the Conservative Party believes in laissez-faire capitalism and nothing else. We do not. We are a Conservative party, not a libertarian party. As both I and David Cameron have argued, Conservatives have always understood the limitations of free markets on their own. We understand that unless markets are embedded in strong institutions, laws and cultural norms, they can become free-for-alls that are prone to instability and end up benefiting the powerful at the expense of the needy. Indeed, many of the problems we face today have been exacerbated by the weakening of many of those institutions, not least the Bank of England. And today I want to explain how modern economic thinking and research underpins the Conservative approach to policy making after the financial crisis. And I want to look beyond the current debate on regulation to highlight 3 ways in which we must avoid sowing the seeds of the next crisis as we approach the solutions to this one. Underlying our approach are 2 crucial insights into the limitations of markets, one old and one new. The old one is that individual rationality does not ensure collective rationality. And the new one is that even individual economic behaviour is not always rational. Far from being a radical rejection of markets, these insights are now the foundation of modern free market economics, the result of decades of research and policy errors. Consider the idea that individual rationality does not ensure collectively rational outcomes. Now, traditional Keynesian macroeconomics had little to say about individual behaviour. That's one reason why it and the active demand management it prescribed were killed off by a combination of the stagflation of the 1970s and Robert Lucas's rational expectations revolution. His Nobel Prize-winning insight was that economic agents would not be fooled by the government's persistent attempts to reduce unemployment by pumping up demand. Instead, they would just expect prices to rise, and the only result would be more inflation. Lucas showed that economic models which were not based on understanding the behaviour of individual economic actors would break down when used to predict the effects of policy. So just because pumping up demand worked the first time a government tried it, did not mean it would work again. People would get wise to it and adjust their expectations accordingly. But rational expectations posed a problem of its own. Why did markets made up of rational agents sometimes result in outcomes like mass unemployment that nobody would ever choose? And the eventual result was what became known in the academic literature as New Keynesian economics, although it had very different policy prescriptions from those of John Maynard Keynes himself. Agents in most modern macroeconomic models have rational expectations, but simple and realistic market imperfections mean that when their actions are aggregated, the results can be far from rational. So seemingly harmless assumptions, such as the possibility that prices and wages might be sticky and not respond immediately to changes in costs or demands, can result in persistent unemployment. And models of this kind underpin our whole macroeconomic policy framework. In particular, the idea that by using monetary policy to manage demand and control inflation, you can keep unemployment low and stable. And they underpin the argument that David Cameron and I advanced last autumn, that monetary policy should bear the strain of stimulating demand in the recession, an argument echoed by Mervyn King last month when he said, and I quote, that monetary policy should bear the brunt of dealing with the ups and downs of the economy. We now appear to be winning that argument hands down. The idea that individual rationality does not necessarily ensure rational outcomes is also a feature of many models of financial markets. Keynes himself famously likened investing in financial instruments to a beauty parade where competitors have to choose the faces they think will on average be found prettiest by the other competitors. His views may have something to do with the fact he himself lost a huge amount of money in the 1929 stock market crash. But modern economics has now developed sophisticated models of rational bubbles where imperfect information or misaligned incentives can lead rational investors to drive prices far away from their fundamentals for a prolonged period. And the effects are magnified when they are combined with a second and much more recent development in modern economic thinking, the understanding that individuals themselves might not always act rationally. This is known as behavioral economics. It challenges the assumption that the economy is built from the rational calculations of millions of members of a species whom Professor Richard Thaler has called Homo economicus. It is a curious it's a curious species, Homo economicus. Homo economicus maximizes profit in every human encounter. Homo economicus never does anything for love or honor or pride or pig-headedness. To Homo economicus, everything has a value and nothing is priceless. In fact, you really wouldn't want to meet Homo economicus. But so much bad policy design has been based on the assumption that that is who we all really are. Let me take an example, the way the tax credit system currently operates. It was designed on the assumption that people would immediately inform revenue and customs of any changes in their weekly income. That was a rational assumption in the sense that if people didn't inform the authorities, they would either lose the benefits they were entitled to or be overpaid and face having money clawed back from them later. So why wouldn't people tell the authorities? And it must have seemed so plausible on a spreadsheet on the then Chancellor of the Exchequer's desk. But of course, as it turned out, people don't quite behave like components of a Treasury model. And it is a shocking truth that millions of our fellow citizens failed to do as they were told. And as a result, billions of pounds of taxpayers' money has been lost on overpayments, and hundreds of thousands of families are now being dragged into hardship as the payments are clawed back. This policy failure wasn't primarily due to administrative or IT errors, although they certainly amplified its effects. It happened because the policy was designed on the assumption that people always act rationally and in their best interest, an assumption that continues to be at the heart of so much government policy making today. Yet over the last decade, social scientists have challenged this worldview in many ways. Nobel Prize winners Amos Tversky and Daniel Kahneman, for example, have shown that the way in which a choice is presented can dramatically affect the decision-making process. For example, people told that an ice cream is 90% fat-free are far more likely to agree to a second scoop than those who are told it contains 10% fat. And patients are more likely to agree to an operation if they're told that 90 out of 100 people survive it, rather than that 10 out of 100 die. This phenomenon is known as framing, and if people were rational, it wouldn't exist at all. Another challenge to the assumption of individual rationality comes from MIT professor Daniel Ariely's work on what is known as anchoring. His insight is that we tend to attach weight to initial prices that once implemented in and implanted in our minds shape not only present prices but also future ones. In one of his most famous experiments, Ariely asked a group of people to write down the last 2 digits of their social security number. He then asked them to submit mock bids on items such as wine and chocolate. Those with high 2-digit numbers submitted bids between 60% and 120% higher than those with low numbers on their social security code. It appears that the simple act of thinking of the first number strongly influences the second number, even though there is no logical connection between the two of them. In the literature, framing and anchoring are known as psychological heuristics, rules of thumbs that people use to make decisions, particularly when they're under pressure or given limited information. Now, the Conservative Party has been trying to make the most of these new policy insights to design better policy in many different areas. For the past 18 months, we've been working with Richard Thaler and Robert Cialdini and others to develop new social policy that more effectively reflects how people really behave. So because we understand the importance of how a decision is framed, we have been working with some local authorities already who are going to try paying the public to recycle by, we are going to try working with some local authorities who are going to try paying the public to recycle by taking some of the money that is saved from the savings on the landfill tax, instead of fining them for not recycling and seeing the litter mount up. So you pay people to recycle instead of fining them for not recycling. Similarly, because we realise that people often make bad personal finance decisions when they're excited by the prospect of immediate gratification, we will impose a 7-day cooling-off period for store credit cards so that shoppers can't immediately rack up debts on them when they sign up to those cards at the till. And because we understand that people are influenced by other people around them, we will require electricity companies to put comparative information on electricity bills so that households can compare their energy consumption with similar homes and their next-door neighbours. We know from California that when people are given this information and find out that they're using more electricity than their neighbors, they quickly take action to become more energy efficient. But it's now painfully clear that perhaps the most important impacts of these sorts of deviations from individually rational behavior have been in financial markets. Non-rational behavior can exacerbate the tendency of financial markets to reach collectively irrational outcomes. This insight lies behind Robert Shiller's irrational exuberance and Hyman Minsky's argument that financial markets are inherently susceptible to speculative booms which, if long-lasting, are likely to end in a crisis. Now, of course, it is easy to point to these theories after the event, once the system has already collapsed. The important thing is to admit mistakes and learn the right lessons so that we can minimize the chances of it happening again. How should we manage financial markets if individual rationality does not ensure collective rationality, and even if individuals themselves are not always rational? Some of the regulatory answers are now emerging in finance. Conservatives have argued for more than a year that in future banks should have to hold more capital through the cycle, that the capital rules should be more counter-cyclical instead of pro-cyclical, and that complex derivatives that we've all been reading about in the last year or two should be traded through clearinghouses. And as we saw at the G20 summit, there is international agreement on the need to eliminate destabilizing remuneration and bonus policies that encourage short-term risk-taking at the expense of long-term results. All of these reforms would dampen the irrational exuberance of markets and limit the damage when bubbles burst. And I'm glad that they are now at the center of the debate. But today I want to look beyond the current debate on regulation to highlight 3 ways in which we must avoid sowing the seeds of the next crisis in the solutions to this one. Because if our solutions are based on the same simplistic economics that got us into this mess, then they're likely to be only temporary sticking plasters. So we need solutions that are robust to market failure and irrational behavior by market participants. First, we need to understand the deep macroeconomic roots of bubbles and financial crises. Now, Gordon Brown claims that our economy was fundamentally sound when it was hit by a banking crisis that came out of the blue from America. It is not a view widely held, even by the Americans. And it's certainly not the conclusion of Lord Turner's report. For what went wrong in our banks was a reflection of fundamental imbalances that were allowed to build up throughout our economy over a decade. British banks became amongst the most indebted, the most leveraged in the world, with tangible assets 39 times tangible equity, compared to just 17 times in the United States. And as an economy, we weren't saving enough to fund this debt. So British borrowers, individuals, companies and government sucked in hundreds of billions of pounds of loans from abroad. The result is that our economy was more dependent on debt than any other major economy in the world: personal debt, corporate debt and government debt. In short, as a country, we were living beyond our means, and our banks borrowed money from China to lend to us so we could buy the goods that the Chinese produced. And we need to challenge the idea expounded by Alan Greenspan and adhered to by Gordon Brown that it is difficult to spot these credit-fueled asset booms and impossible to do anything much about them except to mop up the damage once they have burst. Because it turns out that there is, of course, a lot of mopping up to do. Instead, as American economist Robert Shiller has recently shown, what we should aim to do is identify debt-fueled bubbles as they grow and take action to limit their size. Shiller has found that financial market prices can diverge substantially from estimated economic values for long periods of time. And these divergences can be so large, Shiller argues, that it is reasonable in these situations to conclude that the market prices have become irrational. And the question in the UK context is who can reach that reasonable conclusion? Not a microprudential regulator like the FSA, focused as it is on individual firms who might struggle to see the wider picture. However, the Bank of England could. But that means accepting that the current tripartite regime needs radical change, something you might have thought was obvious after the mistakes of the last 18 months, but something so far the government refuses to do. Conservatives do accept the need to change the existing regime. We propose giving the Bank of England a new responsibility to supervise the overall level of debt and credit growth in the economy as a whole. This is one way to spot rational or irrational debt-fueled bubbles before they burst and try to deflate them gently. And there may be a case for conventional monetary policy to be more responsive to asset prices too. As I've argued before, I don't think it's sensible to use interest rates to target asset prices directly. The danger is that you're using one tool to try and hit two targets and then you miss both. So you end up with more volatility in the real economy, not less. However, there is a considerable debate about whether the current CPI inflation target reflects the true cost of living faced by consumers, and whether the target should be broadened to include housing costs, which were included in the previous inflation target, RPIX. Now, Gordon Brown changed the inflation target in 2003, but in little noticed evidence to the House of Lords a few weeks ago, Mervyn King made it very clear that this made the Monetary Policies Committee's job more difficult. This is what Mervyn King said. Certainly, in the last 2 or 3 years, before the crisis began in 2007, it is fair to say that the change in the inflation target probably made it more difficult for us to achieve that balance. I think it would have been preferable had we stayed with an index in which house prices were still included. Now, the European statistical authorities are currently debating how housing can be added to the Consumer Price Index in a way that is consistent across the EU. But given that we're not a member of the euro, we don't need to be bound by a timetable that may take many, many years. And as I said before, it would be wrong to change the inflation target right now, given the fragility and uncertainty in the financial markets. But a change of government at a national level would provide a sensible opportunity to review with the Governor of the Bank of England what changes would be appropriate so that housing costs are properly reflected in the inflation target. If the first way to avoid repeating the past mistakes of irrational markets is to try better to manage the credit cycle and spot the booms, the second way that we can reduce the risks of sowing the seeds of the next crisis is by understanding the limits of relying solely on hard, inflexible rules to control markets. The new faith in perfect regulation is as naive as the old faith in perfect markets. Of course, new rules, especially on capital and liquidity, will play an important part. But experience teaches us that no rule is flexible enough to deal with every situation. People will often find a way around the rules through regulatory arbitrage and new financial instruments. Just as the Lucas critique applied to economic models that are not based on a proper understanding of how people behave, Goodhart's law applies to targets and rules that are not flexible enough to respond to innovation. Now, this law, named after Professor Charles Goodhart, states that any indicator that is used as a target for policy stops containing the useful information that qualified it for that purpose in the first place. So just as low and stable consumer price inflation stopped being a sufficient indicator of macroeconomic stability over the last decade, it's possible that the same will happen to the sorts of financial targets now under discussion. For example, it's possible that bank leverage ratios will no longer be a good measure of financial risk if they're subject to strict controls. That doesn't mean they shouldn't be controlled, but it does mean that where strong regulation is needed, as in financial markets, rules must be supplemented by powerful institutions who are employed to use their discretion where necessary. Again, the Bank of England needs to be one of those powerful institutions. It used to be said that the one twitch of the governor's eyebrows would be enough to force unruly bankers into line. Well, we will give the governor back his eyebrows in a way that suits modern financial markets. That means locating the macroprudential regulator in the bank, not the FSA, as Lord Turner argues. And it's why we're considering the option set out by Sir James Sassoon, who conducted on my behalf a review of the tripartite system, of giving the bank the backstop powers to step in over the head of the FSA and impose its will on individual financial institutions if financial stability is threatened. The third and final way that we can reduce the risks of sowing the seeds of the next crisis is by reducing the cost when regulation fails. Because we really cannot understand what went wrong over the last decade without being clear that it wasn't just a failure of markets, it was also a massive failure of government policy and regulation. After all, the banks were the most regulated institutions in our entire economy. In Britain, the problem was partly that the regulators focused on the wrong things. ticking boxes instead of challenging unsustainable business models, and monitoring overall levels of debt in the economy. But in many cases, policy actually made things worse. So, for example, the internationally agreed Basel capital rules actually exacerbated the credit cycle because they allowed banks to treat their assets as if they were a better quality than they actually were. The reliance of the whole system on the credit rating agencies meant that the errors were highly correlated across institutions and assets, violating one of the key assumptions of underlying economic models. And in Britain, the government's fiscal rules exacerbated the boom by allowing spending and borrowing at unsustainable levels, leaving us badly exposed. Now, of course, all rules are imperfect, and even strong regulators are sometimes subject to the same inconsistencies and irrationalities as other market participants. So it is safe to conclude that regulatory failure will happen one day again. And that is why it was so hubristic and damaging for the Prime Minister to claim he had abolished boom and bust. We need to make sure that no future government can borrow in a boom and leave us so badly exposed in a bust. That's why we will create, at the heart of the budget-making process, an independent office for budget responsibility to act as a rod on the back of all future Chancellors of the Exchequer. But we also need to reduce the cost to the rest of the economy of regulatory failure in the financial system. We cannot allow one part of our economy to behave in a way that puts the rest of the economy at risk when it fails. And we need to think deeply about whether we can sustain banks that are not only too big to fail, but potentially too big to bail. That's why I believe Gordon Brown is wrong to have ruled out at this early stage more fundamental changes to the future structure of the banking industry. The case for change has now been made by Paul Volcker, Nigel Lawson, the Chief Executive of the Bank of America, and the Governor of the Bank of England himself has called for a public and informed debate on the issue of the future structure of our banking system. So it cannot be dismissed out of hand, as the Prime Minister is trying to do. Now, whether any form of separation between retail and investment banking, even within the same financial group, is feasible or desirable, it is clear that size itself is a risk factor. Not only do large financial institutions do more damage when they get into trouble, but their very size and the too big to fail status may encourage them to behave irresponsibly and take risks that smaller banks dare not take. Now, by dint of its substantial shareholding, the government has a powerful influence over the future structure of the UK banking industry, whether it likes it or not. And when the time comes to sell off those shareholdings, we need to think very carefully before simply selling them to the highest bidder without thinking through the consequences for the wider economy. We should look at whether Britain, in fact, needs more smaller banks. For it would be a bitter irony if we came out of this crisis with a banking system that was even more concentrated and even riskier than the one we had before. That the failure of financial markets does not speak, as many on the left would argue, to a wider crisis of confidence in the free market. Instead, it reminds us of the insights of much recent economic thinking. Markets can behave irrationally. The people who make up markets can behave irrationally. This isn't a failure of capitalism, it is a feature of capitalism. And the issue is, how do we design policies and systems of regulation that take this into account and anchor responsibility at the heart of our economy? In finance, where we have seen the irrationality can do damage on a staggering scale, it means actively searching for debt-fueled asset price bubbles and then trying to deflate them gently. It means recognizing the limits of rules alone and ensuring that we also benefit from the discretion and judgment of strong institutions like the Bank of England. And it means seeking to minimize the collateral damage when regulation fails, as it inevitably will, by looking at creating smaller banks. In other words, while fighting the current crisis, we've got to make sure we don't sow the seeds of the next one. Thank you.